Thanks,
David
gentlemen.
Hunter, welcome
Yes,
to
hi Dale, how are
Traders.
you?
Good. Welcome to Trader Summit, Dave. We've been
thank
doing
you.
this a few years. Really great to include you.
Yeah, thank you for having me.
And I think it's a great start to have one of the most bullish guys on the street in the cosmos to lead off this conference and the summit, because I'm just guessing that you would even be a contrarian among the guests that we have here, and they're all pros. So great to have someone who really, you are a minority opinion now, and I know that's what you love. Tell the crowd what you're looking for as far as the upside in S&Ps.
Sure. Dale, you always seem to pick the good days. I can't tell you how contrary I'm going to sound today. I'm sure versus most of the other speakers, this is going to come across as pretty wild, but I am probably as bullish as I can be right now. And I have been saying for the last 2 or 3 weeks that we could see from 4,600 or a little above that we could see 4,250, 4,300 on the S&P. I'm beginning to doubt we're even going to get that far down here. Seeing signs that we may be turning even today. And I'm still holding to a forecast and like I said, with a lot of conviction that we are about to start, what I'm known for is calling for a melt up, what I call the last leg of a 40-year secular bull market. It will be a parabolic melt up leg. And that seems crazy in the face of what's going on right now, what the Fed's saying they're, just beginning to do. But all I can tell you is my work says that sentiment is very bearish. And it was even more bearish back in February, but at levels that we hadn't seen since March 2020. And that's pretty amazing. We're not, the market doubled in the last 2 years, and yet you've got sentiment back down there.
We were on the air this day, Dave, at the low.
Oh, okay. Yeah.
Remember that? There's a kind of a tendency for us to be together on what might be inflection points. So we were together this day and then successful retest. So with the Fed talking about not just raising rates, but also beginning to reduce their balance sheet with QT, that's not going to make people want to buy stocks either, is it, David?
No, you would think right now would be a time to be selling, and that's what certainly an awful lot of people are saying. I'm actually saying we're at a major inflection point, or an important inflection point in both stocks and bonds. I think we are within basis points of the high watermark for interest rates for this cycle. So I don't think you're going to get the 30-year or the 10-year much above 275. And I think all bonds look to me like they're bottoming. I know last time I was on with you, I talked about the high yield sector looking like an inverted head and shoulder, and that still is holding. It's going back and retesting basically where we were that day. But I think you're going to see that we're at the top in rates, not the beginning of a long cycle up in rates. And the reason for all of this, I think, is because, as I've said for many months, the bond market has done the tightening for the Fed. And along with basically Ukraine did some of the tightening, because look what gasoline prices have done to the consumer pocketbook. You've doubled gasoline prices in the last year and a little. And it's really hitting the consumer hard. Consumer sentiment, University of Michigan sentiment is down at levels that predict recessions. We are, I think, decelerating the economy very fast. You're not seeing it yet in the numbers. You are seeing it in some of the leading indicators of the economy. But I think in the next few months, that's what's going to be the shocker. The Fed's going to be looking and saying, oh my goodness, can we really do these 50 basis point cuts? Hikes? How many more hikes are we going to see? I won't be surprised if the Fed is 2 and done for the cycle. In other words, we've had the quarter point hike. We'll most certainly have a 50 basis point hike in May. They've pretty much signaled that. We might get to the next one in June, but I'm really doubtful because I think the numbers in the economy are going to start showing up. I think what the Fed may do is they may say, we're going to pause on rates hikes, but we're going to continue to shrink the balance sheet, or we're going to start to shrink the balance sheet. And that may be, they pretty much said 95 billion a month is what they're planning.
Yeah,
That may be what they kind of follow through with, for the next several months. And we may not see more than, the May hike. It's possible we see one in June. I'm not saying they can't do that, but either way, my argument is that the long bond, that the 10-year the rates are peaking, and that no matter what the Fed does, the bond market's going to be paying attention to the economy. And I think inflation, although it will lag the economy in terms of the data, I think inflation's probably going to come along behind the economy and be less of an issue as we move through the summer. I think gasoline prices are going to be coming down. I think we've already seen the highs in the oil prices. So there's a pretty good chance that, you could get back up over 100 here. I'm not saying it's going straight down, but I don't think you're going to be 120, 130 again in this cycle.
Okay, Dave. So your narrative here, and I know that yield surprised you a little bit to the upside and me, and especially the acceleration. I thought that maybe we had peaked here at 2%, and then 2.5%, and here we are. So your narrative is that rates are peaking. So instead of it being a headwind for equities and risk, it's going to become a tailwind. And part of the reason for that is there's going to be a breather in commodity prices, and the Fed is going to react more to the economic numbers that it's getting or to pressure in the stock market. What do you think they're going to be paying more attention to?
Oh, most definitely the economy. I think at this point they have signaled, certainly even though Dudley's not on the Fed anymore, and is not, he's just speaking as a private economist. But I think he was speaking pretty much as Powell's thinking would be, which is we need to break the market. We need financial conditions to break here, to break the back of inflation. So I don't think the Fed is worried about the market going back below 4,000 or to 3,500. I think they would allow that to happen if they felt they needed. And I think their thinking is right now that they need to hike rates. So I don't think
they want that to happen. They want to break the market, right?
Yeah, I think they would be happy if that happened.
So why are they going to stop unless the market has already taken that hit?
It's the economy, and like I said, I'm less focused on trying to predict whether the Fed will stop or not. I'm saying the bond vigilantes, the bond market will stop. So I think we are making a top in rates in the longer end of the curve. Can Fed funds continue to go higher? Sure. They're still, they're nowhere near inversion at this point. So you could see the short end of the curve continue to move up. But I think the bond market's beginning to sniff out that what the Fed's going to do is what they do every cycle, and that is over tighten at a time when, and because of the leads and lags, they're going to end up creating, and as you know, my forecast is late this year and through next year, we're going to have a global bust, something that's bigger than any recession we've seen in the post-World War II era. So I think the seeds are being sown right now, and they're being encouraged by almost every economist out there, no doubt, to keep tightening and to hike rates a lot further. And I just don't think it's going to happen because I think we have both massive leverage beyond anything we've ever seen in this world before, and we have a fragile economy because of a 2-year pandemic. And again, it's not just the US, it's the world. And then you add in the war in Ukraine and what that's pushed around. And you've just got a situation. I feel sorry for Powell and what he's got to do here, because he's trying to walk a tightrope. I don't think he realizes how tight a tightrope he's walking, because And I think he's going to find out in the next 3 months as the economy really decelerates.
So if he's tightening into a weakening economy, David, and you think that his policy is really what's going to be, that this is a policy or what he's doing, and he may stop. And most people think that Fed actions should have immediate impact on the market, but isn't there a 6 to 12 month lag on anything that the Fed does now before it has material impact on the economy?
Yeah, I don't know about that because, like I said, I expect second quarter to be negative GDP. So if we're in negative GDP already, at at the end of the second quarter, we look and say, gee, we've got negative GDP. Is it possible that the next quarter bounces? Sure, but we may be in a situation where, and it is very hard because it's people think linear when they try to forecast and when they try to understand the markets. I'm calling for the biggest rally in history. This
Right.
parabolic rally to S&P 6,000 months before I'm calling for the worst economic bust or worst economic downturn in the post-World War II era. It doesn't make a lot of sense other than you've got so much sentiment pushed ahead in terms of negative right now. And then if you get an economy weak, the Fed's going to say, we can't just follow through blindly. We've got to do something. I think the market's going to react to the fact that the bond market is starting to rally, and the dollar will decline with the declining interest rate. So you're going to have that. We're in a very unusual period. Let's just say
You're the
that.
most bearish Super Bowl I have ever met, because
Yeah, I have to tell people it's not medication. It's not because I'm a schizophrenic that's off his medication. It really is the cycle we're in. And we are looking at history. That's what I say, is it's going to be something beyond, 2008 and 9 was pretty wild. I think this is going to be a bigger roller coaster ride than that.
what do you compare it to? 29 or 34 when the Fed
Yeah,
started to tighten, when we were going to recover?
certainly I'm calling for an 80% bear market to follow this melt up. So this is, as I say, I believe this is a secular bull that started in 1982.
Yep.
I know a lot of people have a hard time with that, but I go, that's when we started the whole disinflation cycle that led to much higher PE multiples. You went from single digit multiples to mid 20s.
Yeah.
That entire thing, and you basically in 2008, 9 came back down, made a minor new low in the S&P from the early 2000s, but I view it as all one trend, one secular bull market. And I think this is the end of it. This is the final culmination, will be this last melt up, which is the parabolic final piece. And again, we've been in a parabolic since March of 2020. So I'm not saying that wasn't a melt up, but this is the even steeper final leg to the melt up. And then I think, as I've said, it's like the road runner running off the cliff and realizing it's all air underneath him, and down you go. So
more of a monetary phenomena than anything related. See, so people are going to be confused. The market will be acting good while people on the ground are not going to be feeling as good, because asset prices are going up, but their paychecks aren't keeping up with rent and inflation, everything across the board.
Yeah, and this is going to be fast. I may be, I have a habit of being a little bit early, and things take longer to play out. But I think this melt up could happen in a 3 to 6 month time frame, and I'm really thinking we may, like I said, I thought it probably carry into next week and get down to 4,300 S&P, which is the right shoulder and inverted head and shoulder. You can see down to the line,
down here,
and
down to the wedge where it broke
we
out.
may do that. Yeah, we may do that. I mean, we've got CPI next week, et cetera. But this may be kind of a shortened right shoulder and head right back up. So, and the only reason I say that is because some of the underlying groups are starting to act better. Autos look like they may have turned today. It's early, It may not have, but it's possible. I think semis are in the process of bottoming. So there's some things that tell me that we may or may not, go all the way back down to the 4,300 area. And same thing, NASDAQ, I thought 13.2, 13.4. We may not get quite that far down.
Yeah, the semis may be one more new low, Dave. I know it's one of your favorite groups, and even though you're bullish for quite a melt up, two of the groups that you're saying to avoid, and heard your earlier commentary about crude. I don't think there were
Yeah,
some people looking
yeah,
for 120, but it's acting heavier.
yeah. I think it's acting heavier. My view is that XLE can probably get up to maybe 90. I think that's the right number, another 10, 12 points. But I think that's it. And I think crude, my view is you could see in coming months, crude down into the 60s. And ultimately in the bust, I expect crude down to 30. So I know everybody's looking for 200 and higher.
Yeah.
I am, by the way, next cycle, which is a long ways off, we've got to get through the bust first. But next cycle, I think, is that commodity super cycle. I don't think it's straight from here. I think commodities correct pretty hard in the bust. But I am calling for $400 crude late this decade. So it's not that crude won't come back again, but I think we're going back down to 30 and then in the bust, and then you'll begin a long trek up to much, much higher levels.
Yeah, so it'll be like COVID on steroids, where we went from negative to 120.
Right, exactly.
Right? Okay.
Yep.
And here's your other avoid, Dave. And I've been watching it. I have to ask myself, and want your comment. I know you don't like it because you think yields are peaking out. So I'm asking myself if yields, if this is the best that the XLF could do, at least now, with yields making highs way over when the XLF was here, what's going to happen to these if yields correct back to the downside?
Right. Yeah. This is probably the area where I'm torn because I turned negative, as the thing rolled over. But I think even though, you just had a big shift against the banks in that, the short end went up so much, went up 250 basis points in a hurry. I
Right.
think they've withheld pretty well considering, the big change in the yield curve. If you go back and look at other times when rates start declining, the banks do okay. They do pretty well. So
Okay.
I'm rethinking and saying I think financials may participate in the melt up pretty well. I don't
I
think
mean,
they're,
what won't?
yeah, exactly,
The ARC,
energy.
Kathy Wood stocks.
I think they could double. I think off the bottom, you could see them back to the 200-day moving average, certainly.
So that's just a correction, right? From it won't be new
Yeah, they're
all-time
not going to go.
highs.
I would be surprised if they make new highs for sure,
Okay.
because I don't think this rally's that long. But I do think they can certainly double and still be way below their highs of last year or whenever it was. So I think, and by the way, I have a forecast of 3,000 on the Russell. I think the small caps are going to play. That's the other thing where I guess I'm contrary is
You are.
people are assuming any rallies will be narrow. I think
Yeah.
this rally is going to be very broad. I think it's going to be large cap, small cap, value, and growth because rates are going to be coming down. So you'll get the fangs, you'll get the small cap growth. At the same time, you made a statement before about commodities. I do not think most commodities are peaking here. I have a $6 forecast on copper, and steel's still running. So I think that's why I say the Fed's going to be in a tough place in the next few months because I think the commodities are going to continue to run except for oil. That may be the kind of the ace in the hole for them is that if oil really starts heading down, even though other commodities are going up, energy and certainly gasoline plays such a role in the economy and in inflation that having that go the other way may give them a little bit of wiggle room.
Okay. This is a little off topic, but it's something unusual. What do you think, and have you ever seen it before, where China, PBOC, is stimulating while the US is tightening and being on two different tracks. And do you feel there's any significance with that happening?
Well, yeah, I'm sure we've seen it before. They aren't always synchronized, and certainly China tightened before we did. They were trying to deal with their credit problems for the last year or so. I would not be surprised if China coming back here adds a little bit of wind to the back of U.S. markets or world markets as well, because they've been kind of the one that was going against that for the last year. They've been trying to rein things in a bit. So, and obviously China, if we want to talk about leverage, China's got leverage beyond anybody. So they've got to be careful too.
Okay. All right. So copper, you're looking for $5. Let me ask you this: if some of the economic numbers that are going to create, huh? $6.
$6.
Right, 6, you said.
Yeah.
Yeah, okay. If some of the economic numbers are going to start to worsen like you anticipated, isn't there a potential that oil is not the only commodity that takes a breather? Could it be
Oh yeah,
copper?
yes, I think steel, copper, all the economically sensitive commodities
Right.
will roll over hard. I just don't know that they do it in the next 3 months. I think as we move towards the end of the summer or Labor Day, I would say, yeah, by then you'll see commodities peaking out and rolling over, I would think. But history is that the inflation doesn't break easily. There's still reasons why there's still wind at the back of these things because of supply chain issues, et cetera. So I just have a feeling you're going to see everything's not going to, the timing on everything is not going to fit in the nice, easy, pattern. It's going to be some things will peak before others.
So you're probably going to see the most dispersion and different things that used to correlate with each other not. And really, it's going to be, do you think, kind of more of a stock pickers kind of market than just by the S&P index, or is that the way to go?
Yeah, I think, like I said, I think this is going to be broad based, and most things are going to participate. I mean, my most negative call is on energy stocks, and I still think they have more than 10% upside. So, but they're going to be compared. That's going to be compared to an S&P that has 35% upside and a Russell that has 50% upside. NASDAQ that has over 40% upside. So 10% is going to be a gross underperformance. And then I think they, obviously oil rolls over and the energy stocks roll over. So, but it's going to be, like you said before, it's going to be hard to find anything that's down. I think this is going to be a very powerful rally.
And, we do have that tendency of being around on what could turn out to be a significant day or within a few days. And I know you've been looking for a high in the dollar for a while. And in fact, we're going to get back to the good old days where a weaker dollar means risk on during your melt up phase, because that would be jet fuel for the market, right?
Yeah, and again, it's another wild call, but I think you could see the dollar down from the 100 area that it's at down to 80 in its decline. So, and that basically in the bust, in the real center of the bust, I think people are going to be running to the dollar for safety. So there doesn't leave a lot of time, but I think that big, if you go back to the chart, where we talked about this before, where it had that big climb, that vertical climb, several years ago, I think we can repeat that on the downside here. So you could have a pretty sharp decline.
Like this, David. This was your COVID high.
Yeah, no, this goes back years, Dale. I'm talking.
Okay.
Go put that first chart back.
Okay, you want me to go further back?
Yeah, the one you had before.
Okay, 2002 from this one. This is 2002.
Nope. Don't move. Leave the chart there. I'll guide you.
Okay.
Get back to that other chart.
we
Yeah.
are. Can't
Yeah,
find
there.
it.
So it's the one where it kind of really deviated to the upside off the 200-day moving average. See,
Yeah,
I can't tell what
and up
year that
here.
is, but
That's
no,
2018
back
here.
further back. No, the other way. Right, you just passed it. This long vertical line, what year is that? I can't see. Um,
The vertical line. This one?
anyway, it was a big jump, but dollar went straight up. I'm saying you're going to basically repeat that on the downside. And so you can fall, 20 figures. Yeah, that one, you can see it in.
All right, so you're looking for 80 in the dollar. And
80 in the dollar. And
I think you
that
said,
obviously will be more fuel, I think, for the bull market. It's also another reason why I don't think commodities hit the skids too quickly.
okay. And I want to cover, you're still bullish gold.
Oh yeah, gold and silver. I think the move is just beginning. If I'm right about the dollar, obviously that will help it. I think you're going to see the metals and the miners will be among the leaders in the melt up. So sometimes we think that the metals and miners move opposite to the market. I think they're going to be leaders in this market. So I've had a forecast of 2,500 gold for this year and $50 silver. My $50 silver is still there. I haven't changed that. My gold, I have my investment letters coming out next week, and I've changed my gold target. I won't say it till the letter's out, but it's going to be higher than 2,500. And
look how much stronger the miners are than gold. So here's gold.
Yep.
Right. I mean, we've hardly recovered off that break, and most of the miners are pushing to new highs, which is the opposite of what's been going on for the last year or so, where gold has outperformed and the miners have underperformed. So that's a bullish sign, right?
Yeah, it is a bullish sign. I think gold may be waiting for the dollar a little bit more, but the miners are starting to pick up that things are turning. And I think it's a beautiful chart. Like I said, 2,500 will be exceeded by, I think, several hundred. And, silver 50 to me is a minimum. And the miners, will do very well. Obviously, they usually outperform the metals on the way up. So I think we're in a sweet spot. It took a long time to get here. We've been in a long consolidation after the run from March 2020 to August, but I think they're going to break out and really take off. So, again, is that related to inflation? I think inflation is going to lag the economy. You're going to have inflation problems for a longer period, meaning months, not years. But I think they are in gear. So it's been, you corrected them earlier, in the last several months, and I think they're about to emerge from that correction now.
Okay, do you have to be discriminate when you talk about the FANG stocks, David? Because, I can see things like Apple looks okay, but Netflix looks like a broken stock.
Yeah, I've looked at all of them. I can't comment on individual stocks, but I will tell you that I believe all 5 of the FANGs are going to perform, including that one. So I think that they will be very big participants in this. Again, once we get to the bear market, it's a whole different story. The leaders of this cycle are going to get hit very hard in the bear market. So this is a last hurrah, in my opinion. But across the board, I think the FANGs look good, as do other large cap.
They could at least maybe run and fill the gap on.
I think
not
so.
All-time highs.
I think all-time highs is very possible.
Okay. Thinking about, you follow the ags at all, or natural gas? That's a little different animal than WTI. And
yeah,
Go ahead.
I chose to sit out natural gas this cycle, next cycle, because I think the next cycle is going to be so huge for all commodities. I'll
Okay.
get on board, but it's a hard one to call. Obviously, it's done well and could do well for a while longer, but I'm not close to gas. The
Maybe your
ags,
wife didn't let you trade this cycle because it's called the Widowmaker.
yeah, that
And she
could
wants
be.
to keep you around, David.
Yeah, it's not a good idea to be contrary and wrong. That would be death. So,
All
but
right.
yeah, I think all commodities are going to be multiples of where they got to this cycle. So the next cycle is going to be huge for gas and oil and metals and everything else. Ags, I'm not going to try to call them short term. I will say that the next cycle will be huge for ag. Obviously, they've had a great run this year.
I sure have. There's
And
beans.
I think it's just the beginning for them. But again, I think probably ag too, all commodities are going to get hit pretty hard in the bust. You know, that global bust is going to be, I use the term bust to differentiate it from a normal recession. I say it's something that's the magnitude in some ways of a depression because of the financial crisis that will accompany it. But it'll be the speed of a recession. So it'll probably be contained within mostly a 12-month period. But with that kind of downside, it's going to hit commodities very hard. So it's just
should take time to repair, don't you think, like everything else? Or is the Fed going to be able to turn it into a V bottom, or will it be more of a saucer bottom recovery after that?
Yeah, the thing that will change it from a saucer is I think probably the easiest part of my prediction, or the easiest thing to predict, is what the response is going to be to this bust. Not necessarily the timing per se, but there is only one tool that they will have, because I think that this is going to be accompanied by the biggest global financial crisis in history, which means bigger than 2008-9, which means some major bank failures around the world, not necessarily US. It will require money to the tune of, I think the Fed's balance sheet will grow to 30 trillion. I think, the central bank balance sheets around the world will grow proportionally. That's what's going to be required to stem a free falling financial system. And that's what I think we'll be facing. And so if you print, if the Fed alone puts 20 trillion into the system, and then you get the same from all the banks around the world, it's going to cause an explosive inflationary recovery with a lag. I mean, it's not going to happen right away, but within a year lag or a 9-month lag, you will see a recovery that will pick up speed as it goes. But it will be a 1970s, early 80s story, and a lot bigger than what we've seen in the last year in terms of how much nominal growth doesn't measure, real growth doesn't come through because inflation's taken off. So between, say, 2024 and 2030, you could have inflation retrace. It's not such a big story now, but I was saying this before this last year, retrace everything that we saw in the last 40 years. So you'll go back to 20% inflation rates, 21% T-bill rates, 15% long bond, 15% 10-year. And so it's going to mean a whole different leadership. If you're in commodities, you'll be able to outpace that inflation. If you're in
what do you do with real estate here, Dave?
I think real estate's peaking this year. If you're talking about housing, I think real estate's peaking this year. Maybe it bounces in the melt up. Some pockets around the country can make new highs because we have so little inventory. But I think you're in the process of peaking real estate, and I think that peak may stand for decades. As I say, the peak in the stock market, 6,000 S&P, 20,000 NASDAQ, 45,000 Dow, the high water mark, wherever it is in this melt up, will probably stand for decades. So I think housing the same story.
Okay, David. Well,
Mr. Hunter, hey Dale.
Go ahead.
Can I interject?
Steve Volge, one of my associates.
Steve Volge, yes.
Hi, Steve.
Hi, nice to meet you. I first of all, I wanted to forward a couple of questions that we have, but before I do that, I wanted some clarifications from you. For example, let me start from the latter one. You just spoke about real estate, right? So if the prognosis that inflation is going to skyrocket higher, which, to be frank, seeing how they how they act now that inflation is already approaching 10%, that's that wouldn't surprise me that much. But how do you think real estate prices can really depreciate substantially in nominal terms, I mean, if inflation keeps on being 20%? Yes, I agree. Real estate can be hit severely in real terms, but in nominal terms?
Well, here's my question to you. What happens when mortgage rates are double digits? Because the price of the house is typically the inverse of rates. How are people going to afford a mortgage payment when rates are, say, 12 or 14% versus a 2 or 3 or 4% mortgage rate? So that again, there are going to be parts of real estate that can do very well. Farmland, I think, and some of the things surrounding farmland can do very well. I just have a hard time understanding, how the affordability works if mortgage rates are in double
No, I'm
digits.
100% with you. I think there's going to be a major hit to housing, but mostly in real terms, because you can't have inflation of 20% and still get a major depreciation in real estate prices. I mean, real estate prices will initially fall likely, but then they will probably remain more or less steady, as of course the real value is going to kept being lost due to inflation, right? But I mean, the hit in nominal terms is going to be much less if inflation is as high as 20%, right?
Yeah, just understand the bust, even though it's only going to be, say, 12 months is what I'm, 12, 14 months or less, is going to be, in my opinion, going to be a deflationary bust. At least technically, you're going to see commodities come down so hard, oil falling from 100 and some odd dollars to 30 is one of it. You'll see copper probably come down through $2 from $6, those kind of things. So I think you will have statistically, I think, deflation in the next, 12 to 18 months. I think housing could come down. And again, it's obviously regional, so it can be different around the country, but you could see across the board, say 20% hit to housing. Coming back from that, don't forget, if you really hit the economy as hard as I think it's going to be hit, and the economy is as fragile as it is, I think you're going to have consumers not in really good shape. So you've got a slow slog coming out of that hole. And then as rates pick up, because they're not going to pick up right away, you're going to be down. I'm predicting a 0% 10-year in the bust. So the 10 years, 270 now. I think it falls to 0 in the bust and then starts to climb from 0 to, say, 15%.
Yeah,
that sounds crazy that it can all happen
it doesn't.
in this decade.
It doesn't. The only big conundrum.
That's the headwind, is that big climb in rates as you move. You might have a pocket in 24 or 5 where rates are so low that those that can, have balance sheets and can afford to buy homes you might see a bounce. But I think as you get to the middle of the decade and rates are starting to move to double digits and beyond, that's where I think is going to be a huge headwind to move prices forward. Now, I don't know how much they get hit negatively, but I just don't think it's going to be an inflation hedge, even nominally.
Thank you, David. Anything else, Steve?
Yeah. And we have a few questions to forward as well. Okay. So you think that when the Fed pivots, inflation will have already started going down? Because the big conundrum here is, we know how it happened in the past. They had an excuse. Oh, inflation is low, so we can do quantitative easing, we can slash rates, etc. But how exactly does the Fed pivot with inflation at 8%? That's the big question there.
Yeah, they won't revert. I don't think you'll see it in this summer. In fact, I think that's part of what the trigger for the bust is they may choose to hold off on more rate hikes, or they may not. But I think they're not going to hold off on shrinking the balance sheet. And I can't stress enough that what makes this cycle so different than any other is how little room they have to not print money. If they do any tightening of the balance sheet, I think with a lag, and we all know there's lags, they're not going to know it a month later, but
Absolutely.
by the end of the year, we may find, even though it was at such low interest rates, and even though, they printed $5 trillion before they started this, and they only took off, say, a half a trillion or a trillion, we are going to find out that there was no room for error. And they did the same thing they've done in every recession, and they went too far, not realizing they were going too far. The leads and lags, no matter, and it's not because the Fed's stupid. They know there are leads and lags, and they know, but we're in a very different cycle than ever before. The pandemic certainly made it different. $300 trillion in global debt makes it different. Quadrillions in notional value of derivatives makes it different. There's no room for error here, and they have
trillions of unfunded liabilities in all countries make it also different.
Yes.
There is a question. Yeah, go ahead.
I just think it's the perfect storm. I just don't think there is any cycle that they can look at and be able to compare to, because they're typically trying to operate on precedent. And even 2008-9, we're so far beyond that in terms of leverage today.
There are two interesting questions. One is, when does the Fed and QE no longer work? At what size of the balance sheet it outcrowds the markets? Do you have any assessment on that? I think it's a hard question to answer, but it's an interesting one, because at some point the law of diminishing returns should make it irrelevant, right?
Yeah, I'm a monetarist, so I really believe money is, with very inconsistent leads and lags, money is the key, not rates. And so I do think money matters. And my response would be, when you take a balance sheet from 9 trillion to 30 trillion, and again, I'm guessing at what it's going to be, but you are putting so much money into the system that it overwhelms whatever lost connection there is there. It just overwhelms the system, and it will be inflationary, and it will create growth temporarily. The problem is, in the part of the equation I can't answer, and this isn't his question, but is how does the U.S. Treasury handle a debt situation that they can't afford to fund at 4%? How do they handle it when rates are, double digit? There, as well as I do, their first response is going to be, because it's going to be eating up all their budget, we're going to float more debt to service our debt. That ends pretty quickly, because it's like, opening a fire hose of gasoline on a California forest fire. It's not going to work. You're going to have more inflation and even a bigger problem. But the politicians, that's their first response will be, well, we just have to float more debt because we got to pay for this. And then, a year or 2 years down the road, we're out of the market. There's no more capital market we can access money from. That's when the musical chairs stop. And I think the 2030s look like something 100 times worse than the 1930s. But we have this decade to get through first.
I think it's kind of optimistic that we're going to get it to 30s with that pace. As you very well said, I don't know if I agree with the 30 trillion target that you put there, but one thing is for sure, looking back in the past, every round of quantitative easing has been larger than all the previous ones combined, because otherwise they won't work, right? So the previous one might be more than 10 trillion, right? This last one was it took the balance sheet from 3.7 trillion to 9 trillion. So that's
a good point. I think what we're really seeing here is, I talked about a 40-year secular bull market, but I think what we're really seeing here is we're at the end of a super cycle that I define as the big long cycle between two depressions. And what happens through that whole period since the 1930s ended, we just kept ratcheting up money. We kept ratcheting up. All the excesses are just ratcheting up each cycle. And you reach a point like this where it just goes crazy, and it comes to a crashing halt. It's basically a Ponzi scheme that comes to an end.
The most bearish Super Bowl on the planet. David Hunter.
Yeah, as I say, I'm a strategist. I'm a strategist. I cannot advise. I'm not telling people to play this melt up because it's short. I'm only saying I'm trying to forecast what's coming, not what you should do with it. And as I say, I'm not moralizing. When I talk about what the Fed's going to do in the bust, and what the central banks are going to do in the bust, I get a lot of pushback from people saying, how bad that would be. And I said, I'm not moralizing. I'm not saying it's good. I'm saying this is inevitable.
What's going to be?
This is what's coming.
There is a question. Actually, there are a few more interesting. One, will it be hard, in your opinion, to buy physical precious metals during the bust and/or commercial real estate?
Yeah, the metals, I'll have to beg off and say that's not my area. I can forecast the metals very well, I think, but in terms of when you get down to the dealer side and what's available, obviously it seems to me there's going to be a real problem trying to access physical metals. The paper metals are going to go through the roof, I think, but and the silver and gold is going to be scarce. But it's just not my area of expertise, so I'll kind of beg off of it an answer.
What do you think is going to happen with Bitcoin during such a scenario?
Yeah, I'm not a Bitcoin follower. I pretty much have said, look to other people for that, but it doesn't mean I don't have an opinion. And if people accept it's an uninformed opinion, my belief is we have to see how it holds up in the bust before we can accept it as anything. And I am concerned about the speculative nature of it. A lot, as I've said to others, a lot of it looks like any momentum stock. You get people following it because of the momentum, and then they create a story around it. Where are they going to be in the bust if crypto falls dramatically? And what will it be on the other side of the bust? I think those are questions still to be answered. It's too early. And then the other piece I'd say is the Austrian school hates the central banks. So that the Austrians love Bitcoin as something that's outside the system. And I'm a little concerned that that's kind of a following that they've gathered just because of a certain and it's like I said, I'm not an advocate of what the Federal Reserve or the central banks are doing, but I think grabbing onto this as a solution, I think, is maybe wishful thinking rather than reality. At least it's too early to know.
There is also a question which is very interesting. Where is China, and what do you think is going to happen in this inflammatory economic situation you're describing? What do you think China is going to be doing, and what's going to be happening there during such a scenario? Because it's a big player now, right?
I as I said, what's coming after this short melt up, and the melt up is specific to the U.S. We'll see a global rally around the world, but in terms of melt up, we are the ones that are coming to the end of a secular bull market. Others have not performed as well and aren't in the same place. China's certainly had a big run and then has gone to sleep in the last couple of years. The global bust that follows this last rally is going to be everybody. China's, I think, going to get hit very hard because their leverage is even bigger than anybody else's. But I also think, if you go back to 1987 or 1989, Japan was the king of the world. Everybody thought it was going to take over the world. And it pretty much has been in the bear market ever since 89's top. And the US, came out of that and has had this great run. I fear that we are Japan today and China will be us, so that, going forward, China's probably coming out of the bust, going to be the leader, and we're going to be the follower. But again, China's got a lot of problems, so a lot depends on how they come through the bust. There's a lot that's going to get uncovered in that bust, I think. So that's an open question, I think.
Paraphrasing a question that we have from a friend here, he's talking about the US being the least dirty shirt, as we've heard multiple times. So the question here is, Do you think that this next crisis is going to change that? Is it going to change the US still being perceived as the least dirty shirt in a global situation that's going really bad?
Yeah, that's kind of along the same lines of what I said. I think we have real problems. So does the rest of the world, no question. But I think, you know, certainly what happened with sanctions on Russia, recently, is starting to, I think, and this isn't my view, of course. This is, becoming a view others are certainly talking about. I think it could be the beginning of the end for the dollar as a reserve currency. I don't think that happens in the next 5 years, but I think it begins the process. So if we start losing some of that reserve currency status in the post-bust era, which again isn't a long period, 2024, let's say, to 2030, if it's not that we're going to just all of a sudden not be a reserve currency, but I think we could lose some of our advantages, and that will be one of the things holding us back. I really think, that's why I say, I think the peaks we see in the market this year will not be seen again, certainly in the next decade and probably the decade after that, because I think 2030s is going to be a really rough time for everybody. And part of that is, what the reserve currency does to the U.S. in terms of status relative
So
to
as
its
it happened
trade
with
partners.
the Nikkei at the end of the 80s, that peaked at the end of the 80s and hasn't reached that high since,
Right,
despite so many years of inflation.
right.
Thank you. I think, Dale, I forwarded the vast majority of the questions. I didn't mention the questions that had already been answered by Mr. Hunter as he was, giving us his point of view.
Okay, David, the best way for people to follow your compelling ideas.
Sure. I'm on Twitter pretty much every day. They can reach me there at Dave H. Contrarian.
Okay.
And usually I'm on there responding to questions and stuff. Not every day, but most days.
Okay. Well, Dave, I think the H today stands for humble, because I've watched you, and when your forecasts have manifested, I never see an "I told you so" tweet. And when things aren't working out or being delayed, you're not afraid of saying that you're wrong. So I'm going to go with humble for your
Well, thank
middle
you.
initial.
I should say to people, my calls are not trader calls.
Yeah.
People should not be buying options on the basis of my calls, because my timing is not always that immediate. So
Yeah, Dave is not a day trader or scalper. You're getting macro views, and use your own tools to make up your own mind. And I appreciate you being here and spending this time with us, Dave.
yeah, my pleasure.
All right, great way to start off this summit with the most bearish Super Bowl I've ever met in my career.
Dave, thank you so much for joining us for the event.
Yeah, you're welcome.
Thank you very much.
Good luck with the next 2 days, 3 days, and I think you're going to have a lot more sane people presenting from here on. So.
Well, thank you so much.
Yeah.
All right. Thanks for joining us. And we really appreciate you. And I love it. The most bearish bull I've ever seen.
Okay, you guys, take care.
Take care.
David Hunter, everybody.
All right, Dale, that was awesome. I love Dave. I love having Dave here. It's he's great to have. As you've interviewed him normally on our face webinars, it's always nice to have him here. And it's really great to get him even for a longer period of time for the Trader Summit event. So
yeah, I'm glad
awesome
that viewers had a chance to ask some questions and have them answered by my co-anchor, Steve.
Yeah. And yes, Steve, thanks for jumping in there and taking some of the questions. And
My pleasure.
I just want to remind everybody, as the speakers are coming in, make sure that you are asking some questions along the way. We're going to try to address as many as we can throughout the presentations. Obviously, everybody's going to be a little bit different. As they're presenting maybe a PowerPoint, or maybe going through some charts, maybe we get into some discussions. So the timing will be, it's going to be different from person to person. But you know, when Dave said, I gotta take a step back for a second and say, when Dave said, you know, this isn't necessarily for traders, I disagree wholeheartedly. Actually, you know, the thing as a trader for me is I have to have an opinion. I have to have a bias. If I don't, it's okay, but I'd rather have an opinion or a bias or a theme that I'm trading on, whether it's macro or technical, because it gives me that confidence that I need when I'm trading in the direction that I'm trading. So if I'm long stocks, or I'm short equities, or I'm long copper, whatever I'm doing in the markets, I want to make sure I have a narrative that I'm following to keep me in that trade, you know, despite maybe some bumps, you know, some volatility along the way. So anyway, I say that respectfully from what Dave said, because as traders, we eat this stuff up. We want to have an idea of what we're doing and how we're navigating through the markets. Do you agree with that, Steve? He's muted, but that's okay.
I do, Blake. I think
I said absolutely. Sorry. I was
I
sending
think
email.
what Dave is trying to say is, you know, there's a lot of, you know, you take enough heat on Twitter, and so it's probably compliance where, you know, you don't want people to just go gun ho over your ideas and have to feel responsible for them. So
yeah, and I think that, you know, the trading community, the mature trading community, the people that have been doing this for a long time really understand that, you know, people have opinions, and it's really up to yourself as a trader to make those decisions yourself. I mean, I have everybody's got an opinion because they're like belly buttons, right?
Oh, good,
like,
good
derivation.
belly
button. I'm trying to be nice here, but everybody's got an opinion on the markets, and you know, but it's ultimately the trader that pulls the trigger, understands their risk, knows where you know, what they're risking in the market, know where they need to get out, and that's the most important thing. But having a narrative is so vitally important when we're trading. At least it is for me. I want to take a few moments while we're waiting for Katie Stockton. She'll be joining us very shortly. I want to take a moment to actually thank our sponsors. So let me go ahead and grab the screen really fast, and I'm going to just take you over to our sponsors of the Traders Summit event. 8Cap Securities, you're going to get a little presentation regarding 8Cap and just some of the partners that they work with. They're a great brokerage firm that really provided us the opportunity to do this event for all of you guys. So please take a moment when you can, visit some of our sponsors. We will have a presentation. I'll be doing a presentation actually on the trader funding program a little bit later. It's you know, it's a new way that traders can access larger amounts of money when they're trading the markets. And it's been a great option for a lot of traders over the last month and a half that we've been offering it. Trading Indicators, Market Traders Institute, CMT organization. I mean, the CMT organization has been with us for every event. They've been awesome. And we also have some media partners as well, like FX Street, and then FX Street Media that we recently started working with, and FX Empire. So make sure you visit our sponsors. And I want to also give a very big thank you to Forest Park FX. We've been organizing these events with them. Obviously, I'm from Forex Analytics myself, and Steven Stelios had founded Forex Analytics, and Dale was like our first man to join the team. So, but I want to extend a really warm and gracious thank you to Forest Park FX. The guys, or the team, I should say, over there has been awesome to work with over the last several years, and I can't thank them enough for helping organize this event, because it's this event is not organized by one person, although I think there's one specific person that really spearheads this, Steve, but really it's a team effort, and it's our sponsors that make it happen, and ultimately it's you guys and gals that make it happen as well. One other thing I do need to mention, if you guys and gals don't know that Traders Summit has a website. It's called tradersummit.net. This is one of the, I think it's one of the most utilized websites for our traders in the Forex Analytics community, because you get updated breaking views every day. You know, it's hard to search for new information, new ideas, every single day. Well, tradersummit.net is free. So make sure you go visit the website. A lot of our, well, actually, most of our speakers over the next few days, they are also contributors here on the Trader Summit site. So, take a look around. A lot of great videos, a lot of great interviews, a lot of great just daily columns that are written here. So I wanted to just share that all with you as we have.